December 19th, 2025. The US Treasury releases a number that should make every investor pause. China now holds just $608.7 billion in US Treasury bonds, the lowest level since November 2008, when the world was watching Lehman Brothers collapse and the global financial system teeter on the brink. But here's what makes this moment fundamentally different from the chaos of 2008. Back then, China was our lifeline. They bought treasuries aggressively, acting as the stabilizer, while Western banks imploded around us. They were the lender keeping the lights on. Today, they're running for the exit, and they just hit the accelerator. In October alone, China offloaded $11.8 billion in US debt. That's not some routine portfolio adjustment or technical rebalancing. That's a coordinated exit strategy unfolding in real time. And what they're doing with those proceeds should terrify anyone holding dollars. This is the silent war. No missiles, no tanks, no CNN breaking news alerts. Just systematic, calculated financial repositioning that's dismantling American economic dominance $1 billion at a time. Let me give you a mental picture of what's actually happening here. Imagine you've been flying with the same airline for 12 years. Loyal customer, frequent flyer. Then one day, you notice something strange in their financial reports. Over the past decade, they've quietly sold off 47% of their entire aircraft fleet. Half their planes, gone. Then last month, they suddenly grounded 3 more jets in a single week during peak travel season. Would you still book your next flight with them? Or would you start looking at competitors? That's exactly what China is doing with American debt, except the airline they're abandoning is the US Treasury market, the foundation of global finance. At the peak in November 2013, China held $1.32 trillion in US Treasuries. They were America's largest creditor, the piggy bank funding our deficits, the safety net keeping our interest rates artificially low so we could continue spending beyond our means. Today, that number sits at $688.7 billion. That's a 47% collapse. China has liquidated $631 billion in US debt over 12 years. Think about the magnitude of that number for a second. $631 billion. That's larger than the entire GDP of Poland, larger than Sweden's economy, just vanished from our creditor base. But the velocity is what should grab your attention right now. October 2025, China dumps $11.8 billion. September 2025, another $11.8 billion gone. July 2025, a massive $25.7 billion sell-off in a single month, the largest liquidation in nearly 2 years. Since January 2025 alone, China has reduced their holdings by approximately $70 billion. That's not gradual diversification. That's a systematic liquidation campaign. And here's the part that should keep Treasury analysts up at night. They're not alone anymore. Foreign central banks collectively hold $8.5 trillion in US debt as of December 2024. Sounds substantial, right? Until you see what's happening beneath the surface. Foreign ownership as a percentage of total US debt is collapsing in real time. In 2020, foreign holders owned 33% of publicly held US debt. By December 2024, that fell to 30%. By the time 2025 data is finalized, it'll likely be under 28%. The math here is brutally simple and terrifying. America issues over $2 trillion in new debt annually just to keep the government functioning. Foreign buyers are backing away month after month. That means domestic buyers, US, pension funds, insurance companies, banks, money market funds must absorb the difference. And they're demanding higher yields to do it because they can see the risk building in real time. This is how a Treasury crisis begins. Not with some dramatic press conference or emergency Fed meeting. It starts with quiet, persistent selling that nobody notices until it's already too late to fix without massive economic pain. Let's talk about where we stand today. December 22nd, 2025. The US national debt stands at $36.4 trillion. That's up $2.23 trillion from just 1 year ago. We're adding $6.12 billion per day to this debt, every single day, weekends included, holidays included. While you're watching this video, we just added another $1 million to what we owe. But here's the number that genuinely should keep every American up at night. $981 billion. That's how much the US government paid in interest on the debt in fiscal year 2025. Nearly $1 trillion. Not building roads, not funding schools or hospitals, not strengthening our military or securing our borders, just interest payments. Let me give you context on how insane that number really is. $981 billion is more than we spend on national defense at $874 billion. It's more than Medicare spending at $848 billion. It's more than veterans' benefits, education, and infrastructure spending combined. We are now spending 15% of the entire federal budget just servicing our debt, and that percentage is about to explode. Here's why. That $981 billion was calculated at an average interest rate of 3.38% on our national debt. Right now, as I'm recording this, 10-year Treasury yields are trading at 4.17%. Do the math with me. If we refinanced our entire debt at current market yields, interest costs would jump to $1.6 trillion per year, almost double what we're paying now. Now, we don't refinance everything overnight. That would be impossible. We refinance gradually as old bonds mature and need to be replaced. But that's actually worse, because it means every single month, as bonds issued during the zero-rate COVID era mature, they get replaced with new bonds at these much higher rates. The interest cost ratchets up permanently, month after month, compounding forever. There's no way to reverse it without either defaulting on the debt or inflating it away, both of which destroy the currency and obliterate purchasing power. This is the debt trap economists have warned about for decades, and China just pulled the trigger by crossing that 2008 threshold at the exact moment America enters the most vulnerable fiscal position in modern history. You might be thinking, China's been selling treasuries for years. Why is this moment any different? Because what China is executing right now has been done before, successfully. And it destroyed the previous global reserve currency system. Let me take you back to 1965. Under the Bretton Woods system, established after World War II, the US dollar was backed by gold at $35 per ounce. Foreign central banks could exchange their dollar reserves for physical gold from Fort Knox at any time. It was supposed to be the anchor of global monetary stability, the bedrock promise that made the dollar trustworthy as the world's reserve currency. French President Charles de Gaulle saw through it. He recognized what the US was doing, printing far more dollars than we had gold to back them. America was running massive deficits to fund the Vietnam War and Great Society programs. The gold backing was becoming a fiction, a promise that couldn't possibly be kept if everyone showed up to collect at once. So de Gaulle called America's bluff. In 1965, France demanded $750 million in gold from US reserves. Other countries watched, and they started doing the same thing. By 1971, France and its allies had drained $3 billion worth of gold from Fort Knox. On August 15, 1971, President Nixon appeared on national television during prime time and announced, "I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold." Temporarily. That was 54 years ago. The suspension is still in place. The Bretton Woods system collapsed overnight. The dollar became purely fiat, backed by nothing except the promise of the US government and the strength of our economy. One persistent creditor with a clear strategy broke the entire reserve currency system. Now fast forward to 2025 and look at the scale. China has liquidated $631 billion in treasuries since 2013. That's 180 times larger than France's gold conversion in inflation-adjusted terms. 180 times larger. And just like France, China is accumulating gold while dumping dollars. Official reserves, 2,033 tons as of Q3 2025. Estimated true reserves, including state institutions, over 5,000 tons. The playbook is identical. The scale is 180 times larger. But unlike 1971, there's no gold window for America to close this time. The weapon isn't gold convertibility, it's treasury yields, and those can't be suspended with a presidential decree. They're set by the market, by millions of buyers and sellers making decisions every day based on risk and return. If this is connecting dots you haven't seen before, hit that subscribe button right now. Because the financial media won't tell you this story until treasury auctions start failing and yields are already spiking. By then, it's too late to position yourself. And drop a comment below. Do you think China's treasury sell-off will force a crisis in 2026? I genuinely want to hear whether you think the math forces this outcome or if there's a way out I'm not seeing. Now let me show you what China learned from France's critical mistake. France broke Bretton Woods, but they had no alternative system ready to replace it. The dollar remained dominant for another 50 years because there was simply no viable replacement. No other currency had the depth, liquidity, or infrastructure to handle global trade settlement. China spent the last decade building that replacement. And it's operational right now, processing real transactions at massive scale. October 2015, China launched CIPS, the cross-border interbank payment system. China's answer to SWIFT, the messaging network that processes virtually all international dollar transactions. When CIPS launched, Western analysts dismissed it completely, a vanity project that would never compete with the established dollar system. In those early years, it processed only $800 billion annually. Fast forward to 2023, the latest data available. CIPS processed $56.3 trillion. That's a 47% year-over-year increase. It now connects 1,427 financial institutions across 109 countries. Let me repeat that. 109 countries are now directly connected to a payment system that does not need dollars. Every transaction on CIPS is a transaction that doesn't need dollars. It doesn't need US Treasury reserves held as collateral. It doesn't flow through New York banks where it can be monitored, delayed, or frozen. And it's already working at scale. In 2024, BRICS nations, Brazil, Russia, India, China, South Africa, plus new members, UAE, Egypt, Ethiopia, and Iran, settled $230 billion in trade using local currencies, no dollars involved. Russia and China now conduct 95% of their bilateral trade in rubles and yuan. The world's largest energy exporter and the world's second largest economy have essentially eliminated the dollar from their relationship. India and UAE launched a rupee dirham direct settlement system. Brazil now accepts yuan for iron ore and soybean exports to China. Saudi Arabia, our longest Middle Eastern ally, the country that created the petrodollar system in 1974, is now pricing some oil sales in yuan for Chinese buyers. This is the infrastructure for a post-dollar world, and it's not theoretical or 5 years away. It's processing $56 trillion per year right now. Why is China moving so aggressively from treasuries to gold and alternative systems? Because they watched what happened to Russia in February 2022. After the Ukraine invasion, the US and European allies froze $300 billion of Russia's dollar and euro reserves held in Western financial institutions. Let that sink in. $300 billion that Russia thought was theirs, that they had earned through decades of energy exports, was simply confiscated overnight through political decree. That was a watershed moment in financial history. The weaponization of reserve assets. Every non-Western country learned the same lesson. In that moment, your dollar reserves can be taken away whenever it becomes politically convenient for the United States or its allies. China is moving systematically from weaponizable assets, treasuries that can be frozen or sanctioned, to neutral assets like gold that exist independent of any political system. Gold is the only reserve asset that isn't someone else's liability. US Treasuries are a promise from the US government. If the US defaults, inflates the debt away, or imposes sanctions, Treasury holders lose value or access. Gold is no one's debt. It can't be printed by any central bank. It can't be sanctioned by any government. It can't be frozen in a political dispute. It just exists as a physical asset with 5,000 years of monetary history proving its value. According to the People's Bank of China, official gold reserves reached 2,233.5 tons by Q3 2025. They've been buying gold for 11 consecutive months, the longest sustained purchase streak in recent history. In September alone, Goldman Sachs estimates China purchased 15 tons of gold. That's 23.4% of all global central bank gold purchases that month. One country accounted for nearly a quarter of all official gold buying worldwide. But analysts tracking trade flows and refinery data believe China's true reserves, including purchases by state-owned banks and sovereign wealth funds, likely exceed 5,000 tons. That would make China the second largest gold holder in the world after the United States, which officially holds 8,133 tons. This isn't simple portfolio diversification. This is wargaming, the end of dollar dominance and positioning for that world before it arrives. So we've established the mechanism China is using, the historical precedent proving it can work, and the infrastructure they've built to replace the dollar. Now comes the critical question. What happens next? Let me show you the specific dates in early 2026 when this becomes impossible to ignore. January through March 2026, the refinancing window. Approximately $2.5 trillion in Treasury securities mature in Q1 2026. This is the largest quarterly maturity in US history. The Treasury Department will need to find buyers for $2.5 trillion in new bonds to replace those maturing securities, plus another $500 billion to fund the ongoing deficit. That's $3 trillion in Treasury issuance in just 90 days. Now overlay China's behavior. If they continue selling at October's pace of 11.8 billion per month, that's 35 billion in additional supply hitting the market during Q1 2026. But what if they accelerate to July's pace of 25.7 billion per month? That's 77 billion in additional supply during the exact moment Treasury needs to place 3 trillion. For every $50 billion in net selling by major foreign holders, Treasury yields typically rise 10 to 15 basis points based on historical relationships. If China dumps 75 billion in Q1 2026, yields could spike 30 to 50 basis points above current levels. A 50 basis point spike on 36.4 trillion in debt adds $192 billion in annual interest costs once that debt rolls over permanently. February 2026, the debt ceiling returns. Here's what nobody's talking about right now. The debt ceiling suspension expires in early 2026. The exact date depends on Treasury's cash flow and tax receipts, but it's likely sometime in February or early March. Congress will need to vote to raise or suspend the limit once again. But this time, the politics are fundamentally different. With interest costs approaching $1 trillion annually and climbing, fiscal hawks have real ammunition. If Congress delays the vote even by a few weeks, Treasury will invoke extraordinary measures. That means temporarily suspending certain payments, shuffling money between government accounts, essentially playing accounting games to avoid default. Markets absolutely hate uncertainty. During the 2023 debt ceiling crisis, yields spiked 40 basis points in a matter of weeks as investors demanded higher compensation for perceived default risk. If China accelerates selling during a debt ceiling standoff in February 2026, it's gasoline on a fire. The combination could easily push 10-year yields toward 5%. April 2026, tax revenue deadline. The U.S. government collects the majority of its tax revenue in April. Individual tax returns are due April 15th. If tax revenues come in below Treasury projections, which is highly likely given slowing economic growth and potential recession signals, the deficit widens further beyond the projected $2 trillion. More borrowing required means more Treasury issuance, which means more supply hitting the market, which means more pressure on yields. This is the perfect storm window. January through April 2026. Massive refinancing needs, plus a potential debt ceiling crisis, plus China sell-offs, plus tax revenue shortfalls, all converging. Let me walk you through what a Treasury crisis actually looks like when this unfolds. Stage 1. The yield spike. January through March 2026. China dumps 25 billion per month for 3 consecutive months during the Q1 refinancing window. Foreign central banks collectively sell another 50 billion, following China's lead, front-running what they see as an inevitable crisis. That's 125 billion in net selling hitting the market, while Treasury tries to place $3 trillion in new issuance. Treasury auctions start showing weak demand. Bid-to-cover ratios fall below 2 to 1, meaning there are fewer than $2 of bids for every dollar of bonds offered. Yields jump from 4.17% to 4.75% in a matter of weeks. That's a 58 basis point spike on $36.4 trillion in debt, adding $223 billion in annual interest costs once the debt rolls over at higher rates. Stage 2. The political crisis. February through March 2026. Congress faces the debt ceiling vote during this yield spike. Fiscal hawks see interest costs approaching $1.2 trillion annually and demand spending cuts as a condition for raising the limit. Progressive Democrats refuse major entitlement cuts. Negotiations drag on for weeks, while Treasury burns through cash reserves. Markets panic because nobody knows if the US will actually default on its obligations for the first time in history. Yields spike another 25 basis points to 5.0% as investors demand an even bigger risk premium. The US is now paying 5% on new debt issuance. For context, the last time 10-year yields were sustained above 5% was 2007, right before the financial crisis. Stage 3. Economic slowdown. Q2 through 2026. Higher Treasury yields mean higher borrowing costs across the entire economy. Mortgage rates jump to 8% or higher. Corporate borrowing costs surge. Consumer credit becomes significantly more expensive. The economy slows under the weight of higher rates. Businesses postpone investments. Consumers pull back spending. Tax revenues fall below projections. The deficit widens beyond the projected $2.23 trillion. But the Fed can't lower rates to support growth because inflation is still above their 2% target, currently running around 2.7 to 3.1%. This is stagflation, weak economic growth combined with persistent inflation and high interest rates. The worst possible macroeconomic environment. Exactly what happened in the 1970s. Stage 4. The Fed's impossible choice. Summer 2026. The Federal Reserve faces a decision with no good options. Option 1, raise rates further to fight inflation. This crushes the economy into recession and makes the government's interest costs even more unbearable. Option 2, cut rates to support economic growth. This allows inflation to surge and destroys the purchasing power of the dollar. Option 3, buy treasuries to artificially lower yields through quantitative easing. This monetizes the debt, devalues the currency, and creates inflation. Historically, when central banks face this impossible choice, they almost always choose option 3. They monetize the debt and let inflation run because the alternative is immediate economic collapse or sovereign default. That's the end game China is betting on. They're forcing America into a position where the only politically viable solution is currency devaluation through inflation. This isn't fear-mongering. This is mathematical reality based on current debt levels, interest rates, and refinancing schedules. If you found value in this breakdown, subscribe now so you're positioned ahead of what's coming. Share this with anyone who needs to understand the strategic game being played with our currency. Now let me show you what the smartest money in the world is doing right now. Let me show you what the people with the best information are doing right now in December 2025. Berkshire Hathaway, Warren Buffett's holding company, held $325 billion in cash and short-term treasury bills as of Q3 2024. That's 28% of their entire portfolio sitting in cash. Warren Buffett doesn't hold cash because he's bullish on earning 5% yields. He holds cash because he sees no attractive long-term investments at current valuations. He's waiting for a crisis to deploy that cash into distressed assets at fire sale prices. Gold hit an all-time high of $2,690 per ounce in December 2024, currently trading around 2,600 to 2,650. This isn't inflation fear. Inflation has actually cooled to around 2.7%. This is confidence fear. Investors are buying gold because they don't trust sovereign debt anymore. Central banks globally purchased over 1,000 tons of gold in 2024, one of the highest annual purchase totals on record. This isn't just China. It's Poland, Singapore, India, Turkey, dozens of countries all moving away from dollar reserves toward hard assets. Bitcoin hit an all-time high of $108,000 in December 2024. Currently, around 96,000 to 98,000 as of December 22nd, 12 Bitcoin ETFs saw $34 billion in net inflows during 2024. That's not retail speculation anymore. That's institutional money, pension funds, university endowments, family offices. They're buying Bitcoin as a non-sovereign store of value, an alternative to treasury bonds that can't be printed by any government or frozen by any political authority. Corporate debt refinancing surged 31% year over year in 2024. Why would major US corporations rush to issue bonds when rates are relatively high? Because they see what's coming. Apple, Microsoft, Google all issued long-term bonds in 2024 at 4 to 5% rates to lock in financing before the window closes and treasury yields spike even higher. So what does this mean for you personally in December 2025? If you're holding long-term treasury bonds, 10-year, 20-year, 30-year maturities, understand this. When yields rise, bond prices fall inversely. A move from 4.17% to 5% on 10-year treasuries means existing bonds lose approximately 7 to 8% of their market value. You'll get your principal back at maturity, but if you need to sell before then, you're taking a loss. If you're entirely in cash, earning 4 to 5% in high-yield savings accounts, you're earning a positive real return right now, but barely. Inflation is running 2.7 to 3%. Your real return after inflation is only 1 to 2%. And if inflation accelerates when the Fed eventually monetizes the debt, you're actually losing money in real terms. If you're heavily invested in US large-cap stocks, understand this historical pattern. When 10-year Treasury yields exceed 5%, stocks historically struggle to deliver strong returns. The S&P 500 typically delivers below-average performance when risk-free rates are above 5% because investors can earn decent returns without taking equity risk. What are sophisticated investors actually doing right now? Gold and silver allocation, 5 to 10%. Hard assets with no counterparty risk that perform well during currency crises. Bitcoin allocation, 1 to 5% if you understand the volatility and risk. A non-sovereign, provably scarce asset that's increasingly accepted by institutions. International equities in low-debt countries like Switzerland with 40% debt to GDP, Norway with its massive sovereign wealth fund, Singapore with strong fiscal discipline. Inflation, protected securities, like tips. If you must hold US debt, at least get inflation protection built in. Short duration bonds. If yields spike, short duration bonds lose far less value than long duration bonds. You're taking less interest rate risk. This isn't about panic selling everything. This is about understanding what the smart money, Buffett, central banks, institutional investors are actually doing based on what they see coming. China has dumped US Treasuries to the lowest level since 2008, the financial crisis moment when the world economy was collapsing. But this time, they're not buying. They're selling and accelerating into the largest refinancing window in US history. They've built alternative payment systems processing $56 trillion annually, bypassing the dollar entirely. They've accumulated over 2,233 tons of gold officially, possibly over 5,000 tons, including undisclosed state holdings. They've studied the French playbook that broke Bretton Woods in 1971, and they're executing it at 180 times the scale. The Treasury crisis isn't some theoretical risk for future decades. It's mathematical. It's accelerating. And the trigger dates are less than 90 days away in early 2026. This is the silent war. No missiles, no military confrontation. Just systematic financial repositioning that's dismantling the foundation of American economic dominance. Our debt has reached a level where even normal interest rates create an unsustainable burden. China sees that vulnerability, and they're exploiting it with precision. The crisis is here. The mathematics are inescapable. The only question is whether you're positioned for what comes next.